On today's episode, we're going to talk mostly about economic statistics as it pertains to housing. My podcast is designed to help new and seasoned investors and entrepreneurs break free from the financial confusion by sharing real world investing and business strategies they can use for building lasting wealth and freedom. All right, so today we're going to talk mostly about housing, and most generally, I talk more broadly on the economy. But today I'm going to stick more with housing. I've got a lot of articles to go through here. And then at the end, we're going to just try to dig in and say, what does all of this mean, right? Any particular article, any particular report, any statistic that comes out, it's easy to read into those things when you take them one by one. And it's easy to be wrong, okay, when you take them one by one. But if you read enough stuff over a short period of time, it's a lot easier to see trends and see developments of things that you wouldn't see when you take things individually. Now, before I get into housing, I thought I would kick it off with something totally unrelated to housing, which is an article I found dated August 13. This is out of Fox Business. Business travel surges as companies prioritize face-to-face meetings. Now, this one just kind of struck me as I was reading because face-to-face meetings are something that I think we certainly lost to a large degree in 2020, 21, and most of 2022 before business travel started up again. And I can tell you, in Houston, Texas, in real estate investing in itself, prior to COVID, you could go to some type of investor meeting or investor meetup or investor summit pretty much 3 to 4 times a week, every week, all year long, it felt like. Now, I might be exaggerating by a little bit, but not by much, okay? Prior to COVID, there were tons of real estate investor events across the city of Houston. And now, we were having a conversation, myself and some friends recently, at a new event that has just started a couple of months ago here in Houston. And we're like, man, this is great. This is like the old days. We're meeting face to face. We're doing deals. We're talking about, capital raising and funding and the things that we used to do face to face here in Houston, pretty much on a weekly basis, if you wanted to. That stuff died off, and it has taken so long for it to come back. Now, I've seen 2 new meetups, 2 new events born here in Houston for real estate investors just in the past 3 to 5 months. So hopefully we'll see more and more of that. And this article talks about business travel surging. So let's dig in and see why the author of this article thinks business travel is surging. So it starts off, companies are bringing their employees back to the office. Now, that's a key for those of us that own office buildings and or are investing in office buildings. Companies are bringing their employees back to the office, and they are sending them back on the road. This new business travel index called the BTI shows business travel jumped 15% year over year. Additionally, it showed a 54% increase in travel intensity since Q1 of 2023, which is this new index's baseline year. This is just fascinating. I won't go through the whole thing. If you're interested in it, I've given you the source. You can look that up and read through it. But it says Navient's data revealed an inverse relationship between business and leisure travel As holiday and seasonal travel goes up, business travel dips. Additionally, TSA data showed a 1% dip in overall travel, underscoring the emphasis companies are placing on face-to-face interactions. Market volatility got you stressed. One day you're up, the next day you're down. It's enough to make anyone lose sleep. That's why smart investors are looking beyond traditional stocks and bonds to diversify their portfolio. What makes ILS Capital different? While stocks and bonds swing with market emotions, our investment funds are backed by real estate notes, actual loans secured by real property. This means your investment isn't tied to Wall Street sentiment or corporate earnings reports. Instead, it's connected to tangible assets that people need, homes and commercial buildings. Real estate notes have historically provided more predictable returns because they're based on actual property values and loan payments, not market speculation. It's a completely different approach to building wealth. Ready to add some stability to your investment strategy? Visit ILS Capital at ilscapitalfunds.com/diversify. That's ilscapitalfunds.com/diversify. And learn how our real estate notes-backed funds can help balance your portfolio. Investment involves risks, including potential loss of principal. Past performance does not guarantee future results. Please carefully consider investment objectives, risks, charges, and expenses before investing. The author says, what I think is most fascinating is that the rate isn't the number alone, it's the growth relative to overall travel. Companies are taking more opportunity to have their employees connect face-to-face. Now, the business travel shows a 15% year-over-year spike. And while there is an overall growth in business travel, there's still differences among the industries. This was interesting as well. The author says that this index showed a growth in travel for the financial services sector of 31%, media and entertainment 25%. In contrast, it showed nonprofits down 5%, hospitality and travel down 8%, and healthcare and life sciences down 15%. Government saw a modest increase of 4.4%. So just a new index. I'm not saying that we're going to read a lot into it, but certainly a new index that gives us some indication of what businesses are doing out there as far as travel goes and face-to-face relationships. So let's dig in now into more of the housing side of things. And the next article I want to reference is titled Millennials Are Richer Now. So why can't they stop worrying? Now, this one caught my attention because, I've cited on previous podcasts that millennials are the largest cohort of home buyers in the nation. Now, that is a statistic that I pulled up, I don't know, maybe a year or so ago and started talking about. So when I see millennials are richer now, that's interesting to me. And also, why can't they stop worrying? Because we don't want them worrying. If a particular group of people are worrying financially, they're not going to go out and buy a house. And if they're the largest cohort of home buyers, that's really bad for the housing market. Well, in order to make sure that I'm still accurate in what I'm saying, I went back and reviewed statistics of the cohorts of home buyers to make sure that millennials are still indeed the largest cohort of home buyers. And to my surprise, I found that is no longer the case, which really plays into this particular article. So I'll get into the new updated statistics and update you on what that is. But let's dig into this article first, because it, I believe, explains why millennials are no longer the largest cohort of home buyers in America. So the article starts out. This is a Wall Street Journal article dated August 2. Millennials are richer now, so why can't they stop worrying? A generation that came of age during the 2007-2009 recession and then lived through the COVID-19 pandemic remains anxious, which is just fascinating to me. It said millennials are entering midlife wealthier than they or anyone else expected. Many of them fear it won't last. Now, they are entering midlife wealthier than they or anyone else expected. My millennials are entering midlife? When did that happen, right? My kids are millennials. Well, yeah, they are entering midlife. Millennials were born from 1981 to 1996, which makes millennials 29 years old for the youngest and 44 years old for the oldest millennials. They make up 21.8% of our population, which is the largest cohort in America. Millennials, there are more millennials alive today than any other generation. So they came of age during the 07-09 crisis, and they lived through the pandemic like we all did. Some of the interesting things here, after persevering through recessions in the late 2000s and during COVID-19, millennials now have net worths that are higher than those of previous generations at a similar age, adjusting for inflation. But many think it is time to retire the narrative that their generation got a raw deal, but they remain apprehensive about their futures. In 2016, the median net worth of older millennials, those born in the 1980s, was more than 1/3 lower than expected based on past generations' wealth trajectories, according to the Federal Reserve Bank of St. Louis. But by 2022, when that cohort was in their early 30s to early 40s, their median net worth was more than 1/3 higher than expected. Rising home values and stock prices have helped boost the millennials' wealth, with both hitting record highs in recent years. But that generation saw both nosedive early in their adult lives. Picture this: you found the perfect investment property. The numbers work, the location is ideal, but your traditional bank wants 60 days to close and treats your rental property like it's some risky gamble they've never seen before. Sound familiar? Here's the thing. Most banks just don't understand real estate investing. They're built for home buyers, not investors. And that's where Investor Loan Source comes in. We're a financing company created specifically by and for real estate investors. We know what rental income looks like. We understand fix and flip timelines, and we get that commercial deals move fast. Whether you're doing buy and hold rentals, fix and flip projects, or commercial acquisitions, we speak your language and we can close in days, not months. Stop explaining your business to bankers who just don't get it. Visit ils.cash/fast. That's ils.cash/fast, and work with lenders who understand real estate investing. This is very fascinating to me because it goes to the mindset. Again, the whole point of this podcast is talking about mindset, not only our mindset as investors, but the mindset of other people that make the economy do what it does, that make certain asset classes do what it does. So the article goes on to interview a couple of millennials, and they talk about, what they're thinking and what they're feeling. And again, I don't want to read this entire thing to you, but it's just fascinating to me, the hesitancy that this generation has. And I believe most of our mindset is created by our past experiences. The article says in early 2025, the average net worth of millennials and older members of the Gen Zs was 31% higher than the baby boomers and 20% higher than the Gen Xers at a similar age. Those are the two generations previous to the boomers. Again, this is out of a researcher formerly of the St. Louis Fed. Not everyone is enjoying such success. Among the millennials still struggling to build wealth are those who have large student debt or can't afford to buy a home. Goes right back to Homeownership is one of those things when an adult, a young adult, somebody in their 20s, early 30s at latest, goes out and buys a home, a primary residence in particular, and they just start that path of paying down that home. It adds to their net worth exponentially over those that choose to rent for a longer period. That is certainly playing out in this particular article. Another one is interviewed. He's 35-year-old. He says his peers have adjusted to their vision of what a good life is. It's no longer a home, a spouse, 2 cars, and 3 kids in the suburbs. He said he measures his success by his ability to travel often and rent a nice apartment. So this gentleman has decided he wants to be part of the narrative of this podcast, which is a renter nation. And we'll play out that narrative here in other articles that we'll talk about momentarily. Still, many millennials say that living through the historic recessions primed them to be extra vigilant. Lisa Pettit, 44 years old, launched her design firm in Asheville, North Carolina during the 2007-2009 downturn as her then employer struggled. She still runs the firm, but fears what artificial intelligence might do to her livelihood. She says, when you start in 2008, you have a mindset of scarcity a little bit. Again, going back to the mindset. So that is the current mindset of the millennials. Now, I said I wanted to update some things for those of you in single-family residential real estate in particular. This should be of note. Millennials are now the second largest cohort of home buyers. They buy 29% of the homes in America. While they make up 21.8% of our population, but the largest cohort of home buyers, and this blew me away, is the baby boomers. They have now taken number 1 place again. Baby boomers were born from 46 to 65, so they are currently 61 years old to 79 years old, and they are now the number 1 home buyers in America. They only make up 19.6% of the population. That is the third largest generation living today, but they are the number 1 generation for home buying at 42% of the single family homes. The millennials aren't even close at 29%. Number 3 for home buyers is my generation, which is the Gen Xers. Born from 65 to 81, we are 60 years old to 45 years old, depending on when we were born. We make up 19.2% of the population, but we buy as of last year's statistics, 24% of the homes. And that really tracks with something else that I read from the National Association of Realtors recently. I can't quote all the statistics in it because I didn't find it before this podcast, but it said the largest cohorts of home buyers are now paying way more in cash than they are financing, and certainly more than in previous years. So that makes sense that the boomers and the Xers, those of us that have been alive longer and had time to accumulate more cash, would be buying houses either all cash or with large portions of cash. And this started happening when interest rates rose to a point where those that have to finance the home to the hilt were more prone not to purchase because they're financing more at a higher rate, making their payments much larger. So if you are a real estate broker, real estate flipper, real estate agent, you might take note of the fact that 42%, almost half of the homes being sold today, are now being sold to those people that are older than me. 61 years old to 79 years old. And you might put yourself in a position to say, what do they buy? What would they like to buy? And what would they like that to look like? And put yourself in front of that type of buyer. Now, with that in mind, I wanted to switch, and I promise I'm tying this all together to another article that was dated August 21. The title on this one is only 28% of U.S. homes are now affordable for the typical American household as buying power drops. And this is what we continue to see is an affordability crisis in this country for single family homes. We've got a scenario where home prices have just done nothing but go up since 2009. Now, think about that 2009 to 2025, home prices have done nothing but go up. And in the meantime, because home prices have gone up, that means real estate taxes have gone up. Even if the tax rates didn't go up, the tax value certainly has, which means the tax bill has. And in some cases, the tax rates have increased as well. On top of that, don't know if it is in here. Yes, it is. And I'll get to it in the next article. But we also have insurance rates that have skyrocketed. So we've got interest rates that have skyrocketed, values have skyrocketed, which means that's pushed up taxes, and that's also pushed up insurance, and insurance rates have gone up. And the other part of insurance, not only have the rates per thousand gone up, but the value of the home has gone up, which means now you're having to buy more insurance. All of this has been a perfect storm to absolutely crater affordability. So, with that backdrop, only 28% of U.S. homes now affordable for the typical buyer. Fewer than 30% of homes in the U.S. market are affordable for the average homeowner, as borrowing rates remain a critical barrier. And yes, borrowing rates are a critical barrier, but I would argue that taxes and insurance are right in there with it. And I would argue that the big run up in prices is also a part of it. They fail to talk about that in a lot of these articles. It says as of August, only 28% of homes on the market were priced within reach of the typical household, with the maximum affordable home price for a median income household falling to $298,000. In 2019, that figure was $325,000, according to the real estate firm's Buying Power report. This means buying power is down by nearly $30,000 nationally since 2019, even though the median income has risen by 15.7% in the same time frame. Higher mortgage rates are largely to blame. They love to continue to pound that. While it's not untrue, there are other factors. The District of Columbia and U.S. That's the wrong article. Even as incomes grow, higher interest rates have eroded the real-world purchasing power of the typical American household. This dynamic is forcing many borrowers to adjust their expectations, whether that means looking for a smaller home, moving further out, or delaying the dream of ownership completely. Home prices and interest rates have risen so significantly they've reduced home buying to its lowest level since the mid-90s. Now, this is a key. You know, I love it when people say it's never been this unaffordable to buy a home. Well, here we see that, yes, it was less affordable by the same metrics. It was less affordable to buy a home in the mid-1990s. So this is not unprecedented, is what we're seeing here. It is not unprecedented at all. You know, it's just like when people say it's never been this hot. And then you look at it and, well, yes, we did break a record, but that record was a record that was set in 1978. Well, wait a minute. That means it was hotter in 1978 than it is today. Well, it's the same thing here. People are jumping up and down saying we've never had this affordability crisis before. Yes, we have. It was worse in the mid-1990s. So, that being said, doesn't mean that it's not bad now. To put the rise in borrowing costs into perspective, a 30-year fixed mortgage rate stood in 2021 at 2.65. It's currently at 6.75. This means the mortgage payment on a $320,000 fixed rate loan is $600 a month higher than it would have been on 2019's average rate. That's $7,200 a year additional out of the average buyer's pocket. And that's true. That's 100% true. And then again, when you factor in the higher values of the home, which means the higher taxes and higher tax rates and higher value of the home that you have to insure and higher insurance per thousand rates, it's exponential. And it's way higher than the $600 a month that they're talking about in this article. Realtor.com estimated that in 2019, a $320,000 loan would cover the entire median home price. Today, it would need to be accompanied by nearly 28% down payment just to get that deal done. Milwaukee experienced the highest buying power percentage with a decrease of 10.5%. The maximum affordable home price there fell from $314,000 to $281,000, which translates to a $33,000 drop in the average affordable home price. All metros still at a relatively high share of affordable homes, aside from New York, where just 13% of listings were within reach of the median income household. Conversely, buying power has grown in 6 of the 50 metros since 2019. Cleveland, Ohio saw the biggest growth in buying power as wage gains helped boost the affordable home price more than 4% from $249,000 to $260,000. And in July, half of Cleveland's inventory was considered affordable for median income households. Phoenix, Arizona, Tampa, Florida, and Austin, Texas also saw slight boost in buying power, large in part because of wage growth. I'm going to call BS on that. On previous episodes, we have talked about where home prices have fallen the most. And where have home prices fallen the most over the past several months? Austin, Texas is always number 1, 2, or 3 on that list. And so is Tampa, Florida. So I would argue, yes, there was some wage growth that contributed, but still, I would argue the largest reason these saw a boost in buying power was not wage growth. It was actually home prices falling and getting more affordable. And I think we'll continue to see that trend in a lot of these metros that saw major raises in home prices over the past several years. The article goes on, still, while buying power improved in all 6 of these markets, the share of homes affordable to the median buyer is still lower than it was in 2019. So just to say, affordability is still a big issue. Not that we didn't already know that, but now we have some statistics to back that up. And as we go through this, we're talking about mindset, right? We're talking about mindset. And the millennial generation, up to probably less than 12 months ago, was the biggest generation of home buyers in this country, which makes sense because it's the biggest generation, period, in this country now at 21.8% of our population. And they are at 44 to 29 years old, depending on when they were born. They are still in, a lot of them, the house formation years. They are still in the first-time home buyer years, many of them. Now, many of them have bought homes and they're on their second or third home. But they should still be the largest cohort of home buyers, and they're not. And they are not because of how they feel about the economy. They are still skittish. They have seen people lose it all in 2007, 8, and 9, and that is still weighing on their psyche. And affordability is still a major issue. The last article I want to go through before we tie this thing all up, another one, August 21, is owning a home still the American dream? Why older Americans are choosing to rent. And this goes back to my thesis of we are becoming a renter nation. Owning and maintaining a home may no longer define the American dream for many older Americans. The article goes on to interview a few people. This particular one says, I'm definitely saving money. I don't have the same expenses I did before carrying a home mortgage. So I'm definitely feeling much freer and lighter than I was, this 60-year-old advertising creative director said. I'm in my renaissance, actually. So this lady is very excited that she doesn't have a home mortgage anymore. She says she is freer and lighter renting. This particular person is one of many renters joining a growing trend as rising property taxes, insurance, and repair costs push people 55 and older to sell their homes and consider renting. Between 2021 and 2024, property insurance premiums rose an average of $648 per year nationwide. According to the Consumer Federation of America, data from the National Association of Realtors shows property taxes averaged about 4% of median household income and rise as property values climb. Many Americans 55 and older are considering renting properties for lower tax, insurance, and repair costs. A recent Harvard Joint Center for Housing Studies report found that people 55 and older account for half of all home improvement spending, a share expected to grow to more than 56% through the end of this year. This particular person says she later took a new job, moved to, and began renting an apartment, basically so she didn't have to buy. She said it was a perfect storm. I love my house. My children grew up in the house, but houses are a lot of upkeep. And for me right now at this point in my life, I wanted to live lighter. I know a lot of my friends are launched and are a lot of my friends, our kids have launched or are launching. We are still vital and young and feel like we have lots of life left. And so it's kind of nice to have an adventure. So it's interesting that this article says a larger and larger portion of our over 55 community is choosing to rent. And it's a choice based on expense, based on maintenance and upkeep, but it's also a choice based on a lifestyle of wanting to travel more and wanting to have an adventure, as this particular person in the interview put it. The head of economic research, Neil Dutta, weighs in on it. If the Fed will cut rates and how much that might impact housing, we're not sure. Unemployment rates and more go into this. In terms of the American dream, I think more people are starting families in their 20s, 30s, and 40s, and they still want that traditional dream of owning a home, raising their family, being near good schools and communities. I think the big shift, though, is in this second chapter, meaning after the kids have gone. Another gentleman that was interviewed says, our rental portfolio has seen about a 70% increase in inquiries from people 55 and older in 2025 compared to 2020. Wow. Let's read that again. Our rental portfolio has seen about a 70% increase in inquiries from people 55 and older in 2025 compared to just 5 years previous. He expects that group to make up over 20% of their residents within the next 5 to 10 years. I think people 55 and older now are valuing much more active lifestyles. We are also seeing they value financial flexibility, so they'd rather pay rent than have the money locked up in a house that may be tough to sell. It isn't the most liquid asset. For them, stability isn't really the desirable outcome when all they know is that there are changes ahead. So it's less about knowing they're going to be in one place and more about knowing that they have the ability to modify their situation as life changes. So, not really a big data point, but certainly shows us trends. And again, if we see enough trends, I think we can draw conclusions from those trends. There was another article that had hoped to get available, but I think it's enough data that we probably will do an entire podcast on it, in a continuation of the talk on the United States is becoming a renter nation. Now, we are starting to see trends that the millennials are slowing down on home buying. They were the largest cohort of home buyers. Now they're not. They're second, and by a long distance. We are now seeing an article here on over 55s are starting to look at renting. And that's interesting because over 55 actually crosses two cohorts. It's the older portion of my cohort, which is the Gen X, and it's the younger portion of the baby boomers would fall in that over 55 category. So it's interesting to see these trends as they shift and so forth. And then I think to top this all off, we have to also talk about interest rates. All of these articles focused on interest rates, every single one of them, all three of them focused on interest rates, interest rates, interest rates. And that's where everybody is laying the blame for affordability. And yes, that's where a lot of it belongs. Absolutely. But to continue to blame interest rates for where we are is not really enough. We have to see these trends and say, what's going to change? So if we're blaming interest rates, then obviously, if that's what we believe the only problem is, then there's only one solution. And that solution is, well, rates have to come down. And if rates don't come down, we don't have a solution. And that may be the case. I'm not saying it's not. But I would ask the question, what is the likelihood of that happening? So in order to talk about that, we would have to look at the latest CPI report that just came out a week or so ago. And let me pull that up here. Basically, what we found is inflation is not done with us yet. Okay. Latest CPI figures says that 12-month change is 2.7%, not seasonally adjusted. Core is up 3.1, not seasonally adjusted. Now, the Fed, obviously, we went at this in length a couple of episodes ago, wants to see inflation down to 2%. We're nowhere near there. We are 40% higher than 2%. And over 50% higher if you look at core, just depending on which one we're looking at. So we are way, way higher in inflation than the Fed wants to see. The only possibility that could give any cover for the Fed to lower interest rates is because of the jobs report that just came out a week or so ago. And in that, we found that jobs are not as steady as once was thought. There is a growing concern about the jobs market. So with the Fed having a dual mandate, they've got a lot of thinking to do. They've got a lot of strategizing to do before their funds meeting, or Fed funds meeting this month. And it's going to be interesting to say to see which side of this dual mandate they fall on. Because if they focus more on the jobs, there may be an argument to cut rates. And that cut, but if that happens, I doubt very seriously it's going to be much. It can't be very much with inflation still way above their target and rising over the last month. So it'll be interesting to see what they do. But going back to housing, if interest rates are the only thing that can fix the housing market, don't expect that to be fixed anytime soon. Because while if the Fed lowers rates a quarter point, I still don't believe that's going to transfer to mortgages. I don't think it's going to transfer to the 30-year fixed mortgage, which is what the housing market relies on. Now, will it transfer to commercial loans for commercial product? Absolutely. It'll transfer to construction loans? Yes. Will it transfer to automobile loans and credit cards? Absolutely. But that 30-year fixed is more based on bonds, and bonds, we're seeing yields continue to grow. We're seeing yields continue to increase. Even if that Fed funds rate is lowered by 25 basis points here in September, I don't see that translating to the 30-year fixed. So if that is the case, and the 30-year stays in the mid to high sixes over the rest of this year, we're going to still see a real slow housing market based on that alone. And then when you factor in all these articles that we just covered, I think that there is a big case to be made for the housing market still continuing to be very sluggish and very slow for sales for the rest of this calendar year. That's my take on it. Hopefully that gives you something to chew on so that you can come to your own conclusions. That's the whole point of this podcast, is to give you data, give you information, tell you how I see it and why, and then allow you to make your own decisions on what you think is coming next. We'll see you on the next episode of The Invested Mindset. Thanks for joining us on The Invested Mindset. To continue receiving actionable wealth building strategies, subscribe on Apple Podcasts, Spotify, or wherever you listen to podcasts. Make sure you turn on the auto download to ensure you never miss an episode. And if today's insights move you closer to financial freedom, please take a moment to leave us a rating. It helps fellow entrepreneurs and investors discover these valuable strategies. I'm Tom Berry, and I'll see you next time as we continue to build the path to lasting wealth and freedom.